Good morning, everybody. It is Monday, February 3rd, and we are going to start our COT report here from the data that came out on Tuesday, the 28th, and we received it on Friday, the 31st. We had a giant washing machine last week. Hopefully, you didn't get trapped in it, but were you panicking on Monday and then trying to go short only to get trapped in the hole? Do you understand the business side of the market and the flows that caused this move up? Do you know what is different between last week's gap down and this week's gap down? We'll dive into that today for our weekly video, but first, a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So, if we look at last week, commercials did add to their net short. And if we go back, this data was submitted on Tuesday, which means that as we made our push to those all-time highs, that's where we see those commercials shorting into that move. And last week, we also mentioned how funds and systematics that chase the move up into that Wednesday, Thursday, Friday all-time high push would stand to lose billions, and they sold 20% of what they bought. So they bought 20% of their portfolios on the way up, and then they sold it on Monday on that big drop, realizing a large loss. And then they started buying back as the month came to a close and bought about a total of 15 billion from our systematics and in the hundreds of billions for our fund managers. And they're going to sell most of that again today on the gap down. So when we closed our CO2 video out last week, we had mentioned that under 6,100 or over 6,150 is where we would see the next trending move. It took a couple of hours, but once the Chinese and Japanese markets opened, we broke 6,100 and made a 150-point move lower. So these were our levels for last week, and then we came right down. And after that 150-point move lower, we just stayed rotational, right in between our rotational from rotational low around RTH open until Friday, and then right back to our mid level. And if you follow our daily plans and our line in the sand, you can understand how this all plays together. We did have several major catalysts, but they all played out as expected. And if we look at the NQ here as well, we put this out at 6:45 on Sunday night as we were gapping down. And again, nothing had changed. Right down to our lower pivot, to our rotational, and back inside rotational, all the way up to our rotational high before a nice multi-hundred point sell-off. So Monday we opened with that large gap down on the DeepSeek AI narrative. And the market moved back up as RTH opened and continually tested our line in the sand. On Tuesday, we had catalysts coming. We know people are nervous after Monday, and the market opened and went lower as traders began buying insurance for the week, as they were concerned about earnings and FOMC. And once the insurance buying is done, when we see the insurance providers in the market move prices higher, they're doing that so that policies lose value. So they're capturing millions only to repeat this throughout the week again and again. And this is the washing machine. So we knew this at 9:30 in the morning, and we get these updates every couple of minutes, and our students do as well. But we were right where we should be, and then all of a sudden at 10 o'clock, we were way over. So this shows us the amount of buying of that insurance that comes in. This is the buying. This is the devaluing of those policies. And this is a big key metric of the business that you can stand to make a very large profit just understanding this concept and having the right tools to capitalize on it. So Wednesday, we then have FOMC, Microsoft and Meta earnings, and then Thursday we had Apple earnings, and we have that down here. You can see clearly. And again, all that happened, we started the day normal and then got way too much insurance buying. And if everybody is concerned about the storm that's coming, about a hurricane or about a disaster coming, and they buy insurance policies, they clear out their houses, they take all their valuables, the storm isn't really going to do that much damage. And that's what we saw again. We had all the buying, and then we made all our move back up after FOMC and Powell speaking. Again, this helps put a floor in the market for us. So Thursday, we had multiple business models playing out this day, creating our price action and closing out the cycles. Again, we had another catalyst. So we also had a $7.75 billion bid in the market. So it was a big bid on Thursday. And this was also quarter end for trillions in the market. And if you don't understand that concept, again, we can help you level up your game. But just as any good business that is heading to the bank to submit financial papers to get a loan, we begin to see the window dressing of the books to make it look a little better, to make our numbers look a little better for the last final push. And so we have the systematics with a very large bid. And this is the pattern that we see play out time and again. So this was Tuesday, Wednesday, and then Thursday. We had the insurance buying ahead of Apple, and then the move higher into Friday. But what was the difference on Friday? What's the pain trade? So all week we continued our march higher. We did close the gap from the deep seek day, but more importantly, we made the move right to our point of control from Friday, and we laid that out in our in our morning video as a key point. Because above that, we started turning billions of buying into billions in selling. Also, there wasn't any insurance this day, so the insurance game that had been played 3 days all of a sudden wasn't. So now, if there is a storm coming and nobody's prepared, we can see the bigger move. And the further downside came, and as we are looking at this, we're gapping down about 1.5% this morning. So for the week ahead, our line in the sand will be key. But the difference between this week and last week is the business cycle is different. Last week was a business cycle ending, and this week there is no end in sight. We have room to push lower. We have a new business cycle starting. We're in the middle of another, actually two other business cycles. So in real estate, it's all about location, location, location. In this game, in trading, it's all about timing and positioning. Our students have access to the tools to see this in real time. So not only do they understand who's in the market, but they can understand when and where it's likely to turn. So the washing machine of the market has been doing its job, taking the money from fund managers, death funds, algorithmic strategies, and hedging strategies. But it's all just part of the business. And Friday was the end of multiple business cycles, and now we're in the middle of two. So we started a new one, and then we're in the middle of two. Actually, we started two new ones. Um, and do you know the dates to mark on these? Stop getting tossed around in the market and chasing price. Instead, understand where billions are coming in and out each day so you can trade like Citadel, Goldman, or JP Morgan and collect money from the markets. If you don't know where to turn or how to see the positioning of these largest players in the market, it's time to level up your game by checking out our courses that we start in March. We also cover currencies, metals, energies, individual equities, and other equity indices for a go anywhere strategy to help you be profitable in any market and in any environment. So for the week ahead here, we are looking for rotational price action on the SPX and the ES futures between 6140 and 6,000. And on the NASDAQ between 22,000 and 21,350.